With the CPI data from the US being slightly worse than expected, what does this mean for the price action of BTC? In this video, we're going to jump down into the technical analysis of Bitcoin, taking a look at what's been going on most recently, what we think is likely to happen next, and all that wonderful stuff. As we get into the video, if you find it useful and informative, smash that like button. We do appreciate that. If you're new to the channel, why not go ahead and subscribe, tap the bell, select all the notifications, and in doing so, you will be kept up to date with absolutely everything that we do here at Cheeky Crypto. And if you haven't yet joined us in Discord, guys, you're missing a trick. Check it out. Linked in the description down below. It's a fantastic community talking crypto 24/7. It's completely free, and I don't think you'll be disappointed by what you find down there, so why not go ahead and check it out? Okay, let's jump right down into this one. Bitcoin paired up with USDT here on the hourly chart, and Binance is the data source. There's a lot of different things going on, everything from Paxos, BUSD, all the way through to SEC's attack on cryptocurrency exchanges. We've seen things with Kraken, we've seen things on staking, we see things now obviously with CPI data not quite being where we think it was going to go, and all that kind of stuff. But what does it actually mean? A lot of it means that we're going to potentially start seeing a little bit more pressure to the downside, but I don't think it's going to happen right away. I think it's going to be a bit of a slow burn, and I think it's going to be a lot of focus on those Fed interest rate hikes, whether or not they're going to be a little bit more aggressive or not. So let me know what your thoughts are on all of that down in the comments below, but let's actually take a look at the price action of Bitcoin here. We can see that we were looking to move down into our kind of fifth wave lows, right, when we're looking for a bit of a move to the upside. My expectations are that we still have to kind of hit this area, but the recent kind of price action has led us into a particular concern of just three waves coming down here rather than five. This means that we might be looking at that ending diagonal structure, meaning that to experience a lot more volatility. For example, with an ending diagonal structure, you normally end up with five waves, and each of those waves contain three waves, right? So you'd have wave one containing three waves, wave two containing three waves, wave three containing three waves, wave four with three waves, and then wave five with three waves, right? So you end up with a 3-3, 3-3, 3 structure. Let me go ahead and remove those. And basically what that would look like is you'd have a wave one, wave two, wave three, wave four, and wave five like this, right? And you end up with this kind of really overlappy kind of structure. Now, there's many different types of diagonal structure. We could have expanding, we could have contracting, or we could just have a kind of impulsive one. So in here, we are looking at this being our wave one, this potentially being our wave two. We're looking to come down into some kind of wave three, up across with an overlap of wave one. This is only allowed in diagonal structures, not allowed in impulsive structures. And then we move down like this. So my expectation is that we're probably going to come down lower than what I was talking about yesterday, which was 21,063 to 21,300. My expectation is that we move down a little bit lower than that. Now, there's a big caveat here. And there's a high probability, now I say it's a high probability, that the market doesn't actually do any of that, okay? And the reason that I say this is our momentum, our oscillator down here, is telling us that this move to the downside right now isn't really being backed by any decent momentum, okay? And so we're correcting down to oversold very, very quickly on the hourly chart. This means that we might push up a little bit higher before we actually move down in that third wave. We want to be a little bit cautious here because invalidation is reasonably close to us. Let me go and repurpose this yellow line. If I put that right on there, you can see that 22,090 to the penny, according to Binance and the USDT pair, this would create an invalidation. We cannot cross this level. So, for example, if we come down here in a wave one, which is just three waves, and then we move up higher than this level, that would prevent us from saying that we're in a fifth wave. We're actually now moving up and we're done with our lows, which is great, right? Because we do want to kind of see some kind of natural kind of correction to the upside, but we want to be aware that until that happens, we are still technically in this fifth wave movement, okay? So we're looking for the breakup there, but I don't think it's necessarily going to be anytime soon. We've kind of got to wait out to see what happens next. Now, when we take a look at these structures, we can kind of acknowledge that there's this kind of three-wave move here. We can kind of acknowledge there's three waves up here already. And the CPI data from today has kind of just knocked us down a little bit, meaning that we might be looking at that next kind of three-wave structure taking us down into those lows. But again, it's not really supported on the hourly chart. Instead, it's more likely to be supported on the 4-hourly chart. On the 4-hourly chart here, you can see that we just broke below the 200 EMA. So again, that would look like we need to kind of move down a fair chunk. We are overbought on the stochastic, and therefore we might support a move of a kind of wave 3 situation, right? So again, if I draw that back in, we'd have a 1, 2, kind of then come down here into wave 3, up for 4, and then down into 5, right? And we can see that kind of bouncing around a little bit. So we want to be a little bit open-minded here, because until we get confirmation of what direction this is going to go in, both directions are technically possible, okay, from an Elliott wave theory point of view. So if Elliott wave theory is not going to help us understand where we are likely to go, what other tools can we use? Well, we can use smart money concepts. We can start drawing in a few things here. We can see that we have this area of selling pressure right up here. Okay, we can kind of see that with all these wicks coming in here and just getting smashed right the way back down again. We can say that this is definitely a high area of selling or supply, right? And the same thing can be said with these wicks to the downside. Down here, we can see that there's a high pressure of buying, which basically means we're stuck in a ranging market until one of these gets a confirmational candle. And it does look like we're in the process of potentially seeing one right in here at the moment, right? But we'd need to come down and close below this low, which was $21,532, right? We'd need to come down and close below that. If we do that, then we can say that we've chewed through all the demand and we're less likely to push on up, right? Likewise, down here at the very bottom, we also have this area just here as well. I'll draw this one in at 21,300 to 21,400. So we can see this low down here. This is also an area where there is some demand. Okay, likewise, our targeted range at the bottom here. So really, we're waiting to see which one of these is going to get that confirmation behind it. Now, when we take a look and we try to find ourselves with any kind of institutional candles or any kind of area where there's a fair value gap, there really isn't at the moment. We essentially are just stuck in this little range. So we're waiting for confirmation to know exactly which way we're going to go. And, you know, for now, Elliott wave theory tells us that it's likely to be down and we need to kind of move up a little bit, maybe on the smaller time frames like the hourly, but down seems to be the direction that we need to go in, and we need to finish off that fifth wave. And the fifth wave is looking like an ending diagonal. We kind of get all that, but it's also possible that, you know, the DXY, you know, dumps down and Bitcoin just, you know, creates an invalidation of the fifth wave and just takes us up into these higher ranges again, because we do have this fair value gap, this imbalance up here that's still yet to be filled. Okay, now I was thinking that was going to happen after the fifth wave, but it could be possible that we just, you know, take out this imbalance straight away. This is $22,084 and $22,464, right? So we know that that's up there. And the other things that we kind of be cautious with, right? If we jump up into my other charts here we have the weekly. Okay, right here, we have a weekly chart with moving averages, not exponential moving averages, just simple moving averages, or not even a simple moving average, just an MA, right? An MA. So here the yellow line represents a 50 moving average and the light blue line represents a 200 moving average. And we had right in here a death cross, and death cross basically essentially is where short-term price movement crosses below longer-term price movement. So it is deemed bearish by many. Again, I don't think overly too much of it, but it is what it is. And we can see that here on the weekly chart. Now, when we take that into consideration, we had a golden cross just up here, right, on the daily chart, right? We had the golden cross, short-term price movement above the long-term price movement, and we can see that happened on the 6th of February. Of course, price only moved down. Again, golden crosses are supposed to be bullish, right? So when you have a golden cross like this, price is supposed to go up, but we saw price go down. It basically means that you can't just take these things as face value. You can't just take a look at a golden cross and think, right, we're going to the moon. Likewise, we can't take a look at a weekly death cross situation and think that we're automatically going to go down. Instead, it's actually probably more important to think about where the resistances are and what was actually creating the downward price pressure in these ranges. Well, you can see up here we had that higher area of supply. Okay, some of our smart money concepts, we can see that right up here. Okay, we can also throw in our 200, this one here, EMA, so our exponential moving average, which we can see was resistance up here, and which created that selling bracket, okay, that little zone up here, okay, and basically brought price down in August. And also we find that this is an area of resistance right now up in January of 2023, and we're kind of moving back down. Now, where are we moving to? Well, we've moved down into this low area down here, previous area of selling. We chewed through all the selling orders and we're coming back down. Has this now turned into a demand area, right? So if we start thinking about where the buyers are going to be, they should be right down here. This previous area of resistance turned support, if you want to think of it that way, or as I like to think of it, this is an area where buyers are likely to be. Okay, so we kind of find our resistances here. We come down into that fifth wave low point on our hourly chart or 4-hourly chart. We hit the demand and then we move on up. Okay, even though we have this kind of death cross situation going on. Now, we also are following our schematics on the Wyckoff accumulation pattern. They're still in play. As far as I can see here, we still need to move down towards the $18,626, and that hasn't changed. So that's still in play. That's still kind of where we're heading and all of that kind of wonderful stuff. So none of that has changed. We're keeping an eye on this one. it'll be whatever it'll be. I'm not too fussed about the Wyckoff accumulation patterns myself. I much prefer to kind of keep an eye on market structure from Smart Money Concepts and Elliott Wave Theory, of which you can check out 𝗕𝗘𝗪𝗀𝗀com, linked in the description down below. You'll find everything you need to know about those things over there. So essentially, yeah, that's kind of where we are with this one. It looks like we still have a small bit of a move to the downside, and then we're looking for a relief rally upwards. It does look like we have to wait for confirmation of which direction this is going to go in, because at the moment this ranging market is a very, very difficult read, and it can go in either direction. So patience is going to play dividends here. Essentially, you're going to want to make sure you get confirmation of the right direction. You don't want to just jump in and gamble on going up or going down. Kind of wait for the market to tell you which direction that's going to go in. At the moment, it's really the oscillators that are throwing me on this one. If we take a look at divergences, we've got some hidden bearish divergences up here. So again, it does indicate that we are likely to move down, but yeah, I'm just going to kind of rather wait to see how this one plays out. I think our volume here has spiked up quite a bit with the selling, but again, it's come right back down again. We'll be paying attention, I think, to where the price actually goes next. Let's kind of keep open minds and see where it kind of goes. For now, if we do complete the fifth wave down lower, we complete an ending diagonal, we're probably going to have to kind of find support probably around the $20,000 level down here, and then we'll talk about coming up into this fair value gap, this imbalance that we saw with the institutional candle, which if I unhide this, you can see right in here. Okay, this is the candle that is in question. We basically drop and we haven't come back up into this range, right? We kind of tapped here, which was a double top with this candle, but we haven't actually come into this range to basically retest this area and fill it up. So essentially this drop right here is an institutional candle. This is what they call them, and they call them institutional candles because the volume and the money that pushed the market down has left this gap behind, and you can kind of see it with these three candles here. You can also see where the liquidity gets hit as well, and all the liquidity testing down at the bottom here that has been going on. Now, from an Elliott Wave Theory point of view, this is a very typical Wave 3 situation. This is kind of what you expect to see from a Wave 3 because it is usually driven from institutional investors. So this is the area that we're looking to come back up into. Just here, it's a little bit messy when I turn everything back on, but you kind of get the idea. We're looking to either move down, complete Wave 3, or invalidate the Wave 3 situation and come back up into that gap being between 22,090 and let's say on the higher range it is 22,464. So that's kind of where we're looking to go. Essentially, everything else is pretty much the same as it always has been. Retail investors remain to hodl, and institutional investors basically still sell, and they're basically selling to retail. So no real huge adoptions have from large institutional investors have occurred. We can bring up our charts here. We can kind of see we have some whale investors kind of just messing around like they have done previously. We can obviously see the Kraken size wallet, nothing changed over the last few days there. We can see the sharks still kind of messing around up that higher end, but essentially nothing major. If we actually take a look at this on the 365-day view of the whale investors, you can kind of see that there's nothing real major going on here, and all we need to do is here be patient, wait for retail to sell their Bitcoin to the whale investors, and then only then will you actually see significant growth in the price action of BTC. We have to understand that we need big money in order to push the price up to those significant heights that everyone keeps talking about. And of course, in order for the whale investors to be able to buy, someone needs to sell it to them. So what we're doing here is we're waiting for our retail investors to get shaken out of the space, and of course our whale investors will be buying it. This is exactly what happened in 2018. You can see here they accumulate during this bear market because they believe that every single lower low is the bear market bottom until they get to this flat period here where they're going to get shaken out of the space. During this bear market, the whales are doing nothing until they get to that flat period there where the whales are basically buying directly from the retail investors and they start to accumulate. Where are we right now essentially is that retail investors are buying and hodling, and our whale investors are not doing anything. So until our whale investors are coming in, we should not think that the bear market is going to be over. The other thing to bear in mind here is what happened with those large Kraken-sized wallets, the 10,000 Bitcoin wallets or more. We can see that they accumulate during the bear market and then flood the system, flood the markets with excess Bitcoin, bringing in the actual bear market lows. And if we show you what's happening so far in the last 365 days, they've been accumulating during the bear market, and we're waiting for them to flood the system so that Bitcoin crashes down in price. Is that days away? Is it weeks away? Is it months away? I have no idea. But what I do know is that history here, in terms of the participants, is repeating itself, and we want to kind of just be patient and let it play out. So yes, there's money to be made during these bear markets in swing trading. We kind of spoke about that recently with this expected move to the upside. Specifically, we were talking about swing trades with ADA. I was expecting it to move up from 27. It went down to 23, which was a really, really brutal, but nonetheless, it went down and obviously rallied right up into those 40-cent ranges. And so again, we see these opportunities to swing trade, but this is also the opportunity to kind of get out of positions ahead of the next big move to the downside, which could have started. So caution is kind of the word I want to kind of say here. And if you have found this useful and informative, guys, smash the like button. I do appreciate that. If you're new, subscribe. If you're looking for more information on early weight theory and smart money concepts, check out 𝗕𝗘𝗪𝗏𝗏𝗏𝗏𝗏𝗏, linked in the description below, and also join us in Discord. Until the next one though, guys, have a fantastic day.